Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual.
All right. Love it. So yeah, this is a half-century mark that we've been hosting these Friday calls at the close, reviewing various sector and market and industry related news and information. We're going to be walking through the prepared material. We have a few topics to cover this afternoon. For anyone who hasn't joined before, I'm hosting this live on both Twitter Spaces as well as in the GMEDD Discord, which you can reach through wook, wook.gg, and the stages chat there, which let me get that on my other screen. People can submit questions via text or can chime in via the audio here in Spaces if they like. So let's get right into it then. On my screen, I've got the newsletter that Joe sent out this morning. So kind of the three items he called out at the top are the historic strike that the UAW has embarked on as of last night, this lawsuit going on between the United States and Google, bless me, as well as Fed shift. Okay, I'll have to get to that one. So yeah, I'm gonna, let's see, we've got Alibaba here as the first item, so I'll just go through that. China's economy has clearly been weakening, unimpressive results for some time now post reopening. Alibaba has its own idiosyncratic things going on. We've talked about a few times here on this about kind of their, I don't want to call it a restructuring because that's not really a correct phrase, but the basically the divvying up of the empire that is Alibaba that's being worked through, although there has been some cold water thrown on that. This week you had the prospect of them putting on hold their grocery chain business IPO, as well as a personnel change at the C-suite level that was a surprise as they go under this. So China continues to be rather weak. Alibaba, obviously, the stock is traded poorly. All right, UAW. So, this summer, it's been a lot of labor action. Joe, I thought you were going to put that graphic in there. Let me dig it up. 1 second here. So, sorry, I had saved the graphic somewhere else. I thought it was going to be in the newsletter. Give me 1 second. It is in Discord in the general macro channel. Let me bring that graphic over here. So this is Labor Department data. Get my head out of the way. Showing days of idleness from strikes and other labor-related work shortages in the U.S. on a monthly basis. So we'll go back to the 80s. Much higher mix of the population was involved in labor unions at that time. But really, we're reaching strike levels that haven't been seen since the 1980s in terms of days of idleness. And in the context, and that's stoppages involving 1,000 or more workers. And in the context of how much smaller organized labor is as a mix of the population now versus then, really shows you this just huge resurgence in labor flexing its muscles. Both we've seen Teamsters, UAW, the Screen Actors and Writers Guilds, all sorts of spaces, pilots for, say, FedEx, really all across the spectrum. Organized labor has been flexing its muscles, and this data point kind of highlights that we're talking about, multi-decade high levels of striking activity. So, dovetails with a discussion we've had in here really, I feel like every week now for the last couple of months. But yeah, I mean, it's big news. It's UAW striking against all three of the Detroit Big Three. Never done that before. It's an interesting strategy. They clearly, their demand list, I don't want to go through all of it. We can talk about it if people want to talk about it. Their demand list is pretty extreme. I mean, they're asking for their work week to get cut down to 32 hours. They're asking for an immediate 40% pay raise. They're asking for a return of pension plans. They're asking for a variety of things that would effectively bankrupt, in my view, some of these OEMs over the next 5 to 10 years. So clearly the OEMs aren't going to accept the demands that the UAWs put forth. It looks like all three of the OEs have kind of responded with an offer that's about half, at least at the wage rate level, of what UAW's latest demand was. So last night, UAWs decided to go ahead with the strike. Oh crap, I just closed that browser window. Oh well. But yeah, got 150,000 odd UAW members. So the way that they're doing this strike is, instead of just having everyone walk off the job across all of the UAW sites in North America, it's very targeted. So they're striking at one facility for each OE, at least at the beginning here. They've said it could come to an all-out strike, which would also be a first. But I think UAW is trying to, it's kind of like a skirmish, right? They're kind of testing the defenses of the big three, see who's maybe gonna cut away from the other two and give away maybe what they're demanding. I feel like UAW is just overplaying their hand meaningfully, given that the ongoing trend is, as we've talked about on this broadcast many times, the ongoing trend is the shift from the Midwest towards non-unionized states. And this is by Japanese automakers, German automakers, Korean automakers, Tesla, the other American automaker. Every automaker, big three, and the big three too, right? Blue Oval City, I think, is in Tennessee. GM has invested a few battery sites in Ohio, which is your typical kind of territory. But this industry is a game of very tight margins. You've had a big boon to margins in the last couple of years, which the UAW has liked to call out. They clearly have a very long-standing grudge against how they perceive they were treated in the Great Financial Crisis and that kind of bargaining. So, they're doing this kind of limited strike. They're keeping more of their strike fund available, so this isn't costing the union as much. If they'd gone full out from the get, they would have ran through the funds in about 2 months. I worked at Ryder in 2019 when they struck against General Motors, who's a large automotive client of Ryder's. Now, this ripples up all throughout the supply chain. This hurts suppliers. It's going to cause labor impacts to the T1s, 2s, 3s suppliers to the OEs. It's going to cost everybody a lot of money, and the question is going to be who's going to blink first. It's just, to me, it's just really difficult because I can't see the automakers getting anywhere close to the demands that the UAW's thrown out, and there's just this ongoing thing in the background of structurally electric vehicles are going to simply require far less labor, call it 30% less labor. So you have just these structural headwinds to labor in the automotive space that I just feel like UAW is really overplaying their hand. So That's big news. It's a big strike. It's not unique, though, as we just said. It's been the flavor of the year for striking like this. So we'll see how long this one goes on. The 40-day strike in 19 against GM cost GM 3.6 billion in EBIT. So if you think about what EBIT is in, like, I think at the midpoint they were guiding for the full year of 23 was like 12 to 13 or so. We're talking about, if there's a couple months strike, you're going to wipe out the majority of operating income for General Motors. And yeah, it's a loss for everyone. The workers, I think, are going to get paid through the strike fund. Those that are striking, the other ones are getting paid under the current term. So I think the UAW is trying to drag it out and make it as painful as possible for the automakers from a negotiating leverage standpoint, but not burning the fuse too quickly on their capacity to strike, right? Because if they burn through this entire fund, then they can't pay the unionized workers, who are then going to be, in a pickle as they're not getting paid anymore, and that messes with people's budgets. So yeah, it's going to be just really interesting to see what they end up seating, because I just see zero chance that traditional pensions get reinstated. I don't see a chance that the work week gets cut to 32 weeks. And I don't see OEMs accepting, the types of wage hikes that they're calling for, given it's going to just put them farther behind their Japanese, Korean, and West Coast and German counterparts in terms of labor cost, which is a major input cost, second only to materials cost in producing these vehicles. But that's all I've got to say about the UAW strike. Joe, I don't know if you have anything to add, or if anyone wants to chime in from the
Yeah,
audience.
I saw a tweet I liked that summed up the proposal pretty well, so I'm going to pin that up into the nest here. But yeah, 40% increase in hourly pay over 4 years, reduced 4-day, 32-hour work week, faster path to top pay, shift back to defined benefit pensions, cost of living adjustments, and 5+ weeks of vacation, more paid holidays, extended parental leave. So you kind of went over all that, but I liked this tweet because it just kind of put it all in one place.
Yeah, and in this Bloomberg article I have on screen, it has some data points that I had voiced over, but I'll be specific with it. Quote, combining wages and benefits, the Detroit Three have total labor costs of about $64 an hour. That compares to all-in labor costs of $55 an hour at the non-union assembly plants of international automakers such as Toyota, according to sources at Ford who are familiar with competitive labor rates. Labor costs at Tesla are even lower at $45 to $50 an hour, the people said. So again, these are already the most well-paid workers. They are asking for an extraordinary wage increase that would put them completely out of whack with the costs of the non-unionized workers. So it's the big three are in a between a rock and a hard place, and it's kind of been that way, I think, just with the structural labor situation for some time. I don't know how some of them are going to go bankrupt if we're not going to see all three of them survive. I think if they have to raise wages even more above all of their competitors. So we'll see what happens. It's definitely, again, just the summer of labor strikes, though.
Yeah, I'll go ahead and take the next story we have in the newsletter. This one I picked out was the U.S. versus Google. So Google, we all know, the biggest search engine in the world, faces a legal threat earlier this week, when the company goes on civil trial in Washington on allegations of violating U.S. antitrust laws. So Justice Department case I wrote here is aimed at Google's search, essentially whether or not the company uses illegal agreements to sideline rivals. So Google, for example, pays billions of dollars to Apple to be the default search engine on Safari. And Justice Department argues that Google's exclusive deals with Apple and others prevent rivals from effectively competing for search business or improving their products. So that was interesting to me because I don't really see what the alternative is. Like, Safari needs a search engine, and it only makes sense for whoever Apple gives that right to pay for it. If this, if Google ends up in trouble over this deal, do they just, does Apple just go to Yahoo, Bing, like somebody else? It's a weird situation to me. Does Apple ever develop their own search engine? I don't know. It's not really my realm of expertise, but I still found it very interesting. I didn't realize Apple was being paid billions of dollars for Google to be the default search engine. That seems like a lot of money, especially considering I'm sure a lot of people that have Macs don't really even stick with Safari. Maybe they download Chrome or Firefox. But yeah, Rod, curious your thoughts as well.
Yeah, I I mean I'm not sure what percent of people change their default uh, browser search. It's got to be something extremely low. So for Google, I think it's as much about just maintaining themselves as the status quo, the default. I personally don't think there's anything wrong with the relationship, but we'll see. Obviously, Justice Department's case is going to get tried over the coming months, and the extraordinarily extreme kind of outcome would be a breakup of Google. But from most of the experts I've read on it, that doesn't seem to be expected by anyone. But yeah, Justice Department argues that this prevents rivals from effectively competing for search. I mean, I just don't see it.
I don't see it
I
either because what's the alternative? People download, people boot up a new MacBook and Safari opens up and the options say like pick your browser and then it lists, Google, Yahoo, Bing, DuckDuckGo. Like, I mean, everyone's tapping Google anyway. Maybe a few people tap Yahoo or something, just because. But I don't even see how that changes anything.
I have to think if if this were to get um, if Justice Department were to win, like I'd almost expect Microsoft to just step in and pay Apple to fill their shoes, which
Yeah, exactly.
I just
Well,
don't know.
Apple developed
I
their own
mean,
search engine. I don't know.
they
That's
have their own
interesting.
search engine.
I was thinking if they did, that would be
Oh,
interesting.
I mean, look, this the market share is still like Google is 90. Okay, so here's a data point saying it's 92% of all search queries worldwide, which again, it's going to vary by a percent or two. I guess I see 91% here on SimilarWeb. But I mean, you're talking about Google at 91, 92, Bing and Yahoo around 3. So, there's 98, 97, 98% of global search right there. I mean, some people like DuckDuckGo, but that's at 1/3% of market share. I've never even heard of this other one that apparently is bigger than DuckDuckGo. There just aren't that many options in the marketplace, and it's almost like Google search, it would seem, as one of those natural monopolies where it is the best product and the market gravitates around it. Justice is arguing it's maybe nefarious, the agreement between Apple and Google. I just don't see it that way. So we'll see how it resolves itself. I don't really see a realistic, like, I mean, obviously Bing with the whole AI excitement is trying to take a couple points of share, and maybe they do, and who knows, maybe Satya, throws Timmy Cook a couple billy after this case is done to become default. I don't know. I just think this is another one of those silly things where um, a Democratic controlled regulator is tilting at the wrong windmills.
Yeah, that one search engine you're talking about that has 0.5% that you didn't recognize. That's Naver. They're in South Korea. I remember when I was in Seoul, they actually seemed pretty popular just because there were certain restrictions put on by the South Korean government on Apple Maps and Google Maps that like wouldn't allow those two platforms to operate because they don't host their data in South Korea. I believe that was the problem. So then there's like South Korean sponsored, I believe, uh, software like Navier that people use over there instead. So it was kind of weird. Like I find my iPhone and things like that didn't work. So if I lost my AirPods or lost my MacBook, I wouldn't be able to track it, which is a little bit of a scary thought.
Tim Cook's got to fix that. Okay, so that's probably all there is to say about the Google situation there. On the Fed, I mean, I don't want to use too much breath talking about the Fed. Jesus Christ, it's Friday. My brain's not working. I wanted to see what was priced. You've got the meeting next week. It's a 3% chance of a hike. I mean, it's pretty consensus and unanimous that rates will be held steady in next week's meeting. There's currently a 31% chance priced by futures that there's a hike in the November meeting. You know, it still continues to be a really I struggle with seeing why raising the Fed funds rate is going to get what the Fed wants to happen at an accelerated pace. I think quantitative tightening might be a better lever to pull on than just Fed funds. But you know, there's still a chance it goes higher. I tend to think at this point, unless something like there's some big surprise, I to the upside in a variety of things. I struggle to see like you have energy prices kind of bouncing back now, but you know the Fed understands that energy is very you know a very fickle thing, so it usually excludes that. I'm trying to bring let me bring this graphic from my notes, and I'll just make it large here. But this graphic kind of showing a mix of services, well, core services. Sorry, not core services, just services. Services excluding food and energy, goods, food, and energy, all four kind of broken out as separate contributors to the overall inflation figure. And you can see that like goods inflation is gone. I mean, on a year over year basis, it's no longer increasing, and on a month over month basis, it has been decreasing. Energy, you know, is unfortunately going to inflect back positively because after kind of running through maybe the base effects of 22 post-war, year over year it had been in decline in the preceding months. Well, now it's going to ramp back up. Like the core services, though, we keep seeing continued evidence of labor market loosening that while it's still maybe a little too tight for the Fed's liking, I don't see how incrementally raising rates more when they're already somewhat restrictive is going to get them the result they want. I think we're going to look back 6 months from now, and we're going to see the economy weaker than it is now, the labor market weaker than it is now, and the Fed perhaps indicating that it's gotten to the point where it can begin to loosen its restrictive policy somewhat, which doesn't mean we're going back to zero. All that it means is, if the natural rate is somewhere in the 3 to 4% range, that they can loosen policy to get closer to more neutral. And if they do pull off, the soft landing, and that works out that way, then a lot of bears will be in shambles. Perma bears in shambles. But yeah, I think inflation is largely resolved because remember the rate of change is what inflation is. So if like prices are still higher than they were when you compare to pre-COVID, but that doesn't mean that on a year-over-year basis, many prices are rising still. I mean, again, core services, yes, but goods, no. Food, it's dissipating. Energy, well, it's wonky. So I think that the Fed is going to stand pat. Obviously, next week is what's expected, and I would be surprised if they rose, if they hiked again at this point in time. Quite frankly. you included the graphic. I think it's a good graphic of private sector monthly payroll growth, and it's a 3-month average. And I think it tells a pretty clear story that if you have payrolls getting back to normal levels, like we are pretty much at full employment. We've got kind of that balancing going on in labor markets, and there's been upticks in yeah. So I don't know. I think the Fed's done. I think they're in a good spot, honestly, and it's not exciting. People would rather say extreme stuff, but I would note, like, it's definitely raises some questions on what happens with all of these labor instances. We on Wednesday in the open mic had talked about the fact that you've got UPS that just reached a contract with Teamsters that's raising their cost of labor high single-digit percent, and maybe pushing up almost to low double-digit in some spaces. I think it's like 9 or so percent, but they're only raising price under 7%. So mathematically, their margins will be compressed, and that to me is what is going to happen broadly. Is that the extraordinary margins that these companies had realized post COVID, some of it fueled by digitization in their operations, some of it fueled by a consumer that had deep pockets filled by Uncle Sam's coffers. I think we're just getting back toward more normal. I think that the levels of margin that these large companies had been able to realize are unsustainably high. I mean, look, there wouldn't be these labor issues at extraordinary levels if things were okay. And I think what's happening is that labor's saying, we're not getting our share. We don't feel like we're getting our share. In some spaces, it's a very specific. We think this is our last chance because AI is going to come and destroy our livelihoods so quickly that if we don't enshrine the right protections, I think that's especially been true on like the SAG, for the writers and screen actors stuff. So yeah, it's all kind of coming to a head. To me, what it means is that maybe cost of labor continues to outpace what companies can take on price, which compresses margins, which maybe is okay for the real economy, but at least from a corporate valuations and especially large cap U.S. company valuations is just going to highlight how out of whack and how overpriced they are, and how much people are overpaying for those sorts of businesses. But they can keep doing that. It's not like it has to revert overnight. I just think it will. We're going to see. Joe, we talked about like Procter and Gamble, right? There's only so much you can raise the price of Tide and the price of insert Crest, whatever other product of theirs here. When people's wages aren't increasing commensurate with that, like people are just eventually not going to be able to pay up. We'll see what happens. But that's all we had prepared. We've got the Warren Buffett Way for our September book club. We did Fooled by Randomness last month in Discord. I know, Joe, we're kind of finalizing whether we're going to host it in Discord again. I think we're going to still do that. So if you want to listen in, I think, Joe, you talked about maybe us setting up a more dedicated channel so people can talk about the book throughout the month. But yeah, we've got more to come on that. But The Warren Buffett Way by Robert Hagstrom is our September Wook Book Club read, and we hope to catch some of you there. We've gone through some great reads year to date, and we covered Margin of Safety, which might have been a little dense to kick things off in January. Psychology of Money was a fantastic read. I really recommend The Psychology of Money to anyone, whether you're novice or seasoned investor. I think that is really helpful. There were a lot of corollaries actually from Fooled by Randomness and what Taleb was, I think, trying to convey. That Housel did a little more clearly and succinctly. but there's definitely a relationship kind of between the thinking there. We covered Joel Greenblatt's The Little Book That Still Beats the Market in March, Mike Lewis's The Big Short, of course, in April, One Up on Wall Street by Peter Lynch in May, Think Twice by Michael Mauboussin in June, Mastering the Market Cycle by Howard Marks in July, and as I mentioned, Fooled by Randomness last month by Nassim Taleb. So all of those replays are available on our Wook Capital YouTube channel, as are all of these Wook and Review discussions that we host on a weekly basis. So that's all I had prepared for this afternoon. It's 4:35. I saw Chris requested to speak. If anyone in the audience wants to request to speak, we can kind of talk about whatever is on people's minds. And yeah, perhaps we get it done a little bit early this afternoon. We'll see. So, hey, Chris, happy Friday.
Happy Friday.
What's going on?
Can you hear me?
I can.
Oh, okay, cool. Yeah. Not much, just the end of the week. Yeah, and things are going pretty all right. Sorry, I just joined. I kind of missed the rest of what you guys were talking about. So
Big talk today was about the strikes, auto
Mhm.
strikes, and airlines. Maybe. What do you think? Go ahead and just ask you that.
yeah. It seems like their demands are pretty high. I think that's the general consensus online. People are, like 32-hour work week, and the pay increase is kind of a lot higher than, people, I guess, expect. And yeah, a lot of people are doubtful that, UAW is going to be able to push this through, but who knows? The Biden admin is, very pro-union. And I don't know how much about, union, organizing and,
Yeah, we spent a while talking about it.
Yeah.
I don't want to rehash everything.
Yeah.
But, I mean, on net, what we were kind of saying is that the UAW's workers are already compensated far higher than the non-UAW workers in North America, whether you're talking about Japanese, Korean, German, and far higher than Tesla workers. The requests that they're asking for would put them extraordinarily higher. It's just an
Yeah.
unsustainable ask. And my view is that depending on how this resolves itself, some of the big three are just not going to make it. It's they have structurally higher labor cost. The only way they've kind of managed to pump the profits out is by continuing to sell the high profit. I call them land tanks. I see these giant vehicles that literally remind me of tanks on the road. I think the world would be a better place if we all had sedans and small cars, but clearly Americans don't want that. So the big three don't produce small cars in North America anymore, right? The Ford went completely out of that. They can't make money off of it. Their costs are structurally too high, and UAW wants to raise them further. And it's a very complicated issue. I get it. UAW feels like they've gotten the short end of the stick, and they've seen obviously these record profits on the back of COVID for the big three, which again, those profits are not sustainable. They're not going to remain at those levels for Stellantis, Ford, and GM. And we've spent internally a lot of time on at least GM trying to get a sense for what's the right price to pay for GM. And it's just the range of outcomes for automotive OEs is so wide. I don't know why anyone would be invested in any of the OEs. Obviously Tesla's a cult and it doesn't make any sense the way it's valued, but all of these car makers, they have historically destroyed capital, have not had returns in excess of their cost of capital. And it is just a horrible situation that incumbents find themselves in. And I just don't see it.
Yeah, Uber, Rod, I was going to ask you about if you heard about the EU's statement about the Chinese autos.
Yep, we were talking about that last night, Joe. But yeah, the tariff situation, right? I mean, the Chinese have structurally lower costs in terms of labor, in terms of their kind of battery integration and into the supply chain. So, I get it. If I'm Europe, I'm not wanting Chinese to dump their cars into my market and destroy my industry. And the U.S., right, has its pretty high tariff rate on Chinese imports. Otherwise, we would have Chinese vehicles here.
Yeah, I
These
if you look at
industries are
yeah.
like they're just very politically entrenched employees,
Yeah.
that they employ, right? We're talking about a couple 100,000 employees that in a in a labor market with over 100 million. So it's just a crazy thing.
Yeah, and it's just crazy, right? Because that Europe wants to go through this green energy transition, right? And like a lot of the cars that come from China are electric vehicles, right? So like it's kind of like, they want to have these, but they're also complaining, right, that they're, they're subsidizing the industry. I mean, they've invested a lot over a long period of time in electric vehicles that, during times when VW, and I think VW was investing in diesel very heavily in the early 2010s, and some of these other autos, they didn't really shift very quickly. So it's been a lot of growing pain for these autos. And yeah, I don't really see any of them of the autos as a good investment. Like, I mean, I'm in BYD right now,
Well,
but
I think, and you've heard me talk about it. Like, I think that the
yeah,
suppliers, some of the oligopolistic suppliers, are far more interesting than the OEs themselves, because
yeah,
you're getting, and maybe on a price to earnings basis, it's not on its face as cheap as the OEs look right now, but your earnings, I
mhm,
think, will be far more durable
yeah,
than the market seems to imply, right? We've talked about Allison a lot, on the like
mhm,
turbocharger side, of course, like you've got GTX and those sorts of suppliers, who the market perception is, oh my God, EV destroys your business very quickly. We're going to price you like you're
mhm.
a terminal zero. Um, I mean, I think all you have to have is a slightly disparate view from what the market has, which the market view seems to be all electric everywhere very quickly, and that's
Mhm.
just not going to
Yeah.
happen unless there's some
I mean,
massive breakthrough.
so another thing is like companies like Allison have great management teams, and their management has been very good. They've been very consistent. Um, they don't destroy shareholder value. I think those things in an investment are very important too, rather than just like the sector trends. Um, so even though, they may be in a, sector that's, declining, right? Combustion vehicles, they're still, chugging along and adapting. But yeah.
And it gets, I mean, it just goes back. I call it a cult because it really is that they the people who are for all green everything don't kind of allow for reality to come into play. Where as you kind of listen to Toyota, I mean, mathematically, if we just sold all hybrids, since we are very much constrained on the ability to produce 100% EV, you would reduce emissions far more quickly. And it's just not what the cult of green wants to hear or acknowledge. Um, so, yeah, I mean, Europe's shot themselves in the foot. Unfortunately, they've kind of screwed themselves. They're and it's just bizarre the things you see in Europe, where you see demolition of windmills in Germany so that they can get access to the coal veins again. Like, it's very, very, very short sighted. These pie in the sky, you know, green cult thinking that a lot of these countries have embarked on, and it's allowed China to I think China, unfortunately, is going to dominate in the longer run. These industrial policy actions like IRA, it's a little bit late in the game. Given, as BYD is ahead of everyone else in sales on the electric vehicle side. You can, they're gonna. I would posit that you're going to just have a lot more upheaval in the incumbent automakers who have all of their investment in internal combustion. They have their like competitive advantage is the engine in many of their cases. They make a great whether you're Mercedes or whoever, that's the advantage, because you're mostly an assembler. You're assembling all the things around your IP, which is largely the engine. You go to EV and you don't have any advantage. Your only advantage would be if you'd gone in early and gotten some scale economies, maybe some, maybe electric motor competency. Like, I just, it's ugly.
Yeah,
And I think
another
just
thing I've noticed
UAW
is
is
that,
completely overplaying their hand. I don't think UAW, look, if their hope is to only have to negotiate with one or two, in a few years' time, then they're on that path, because
yeah,
you won't have all three.
yeah, and I think with China is really interesting to me is that a lot of the traditional ICE car manufacturers, the domestic ones in China, are now moving a lot to hybrid, like very quickly. People that are shopping for cars, they want hybrids, at least, or electric cars. So like you have like a Great Wall Motors, right? They make one of the best selling SUVs is called the Haval, and they sell globally, but like especially in China, and they're making plug-in hybrid versions of it. And like I went to the Mazda dealer the other day. Of course they're a smaller manufacturer, but they still sell a lot, and they had one hybrid model, and that was it. Everything else is just internal combustion engine, and this is a brand from a country where they pioneered, right? Like Toyota pioneered hybrids, and 20 years later, right? Like Toyota still sells a lot of pure ICE cars, which is kind of crazy.
A ton of hybrids, and they can't make enough of them. The demand is just insatiable relative to the supply Toyota can bring to bear. I mean, I've said it the other week, like I want
Yeah,
to buy I
yeah,
have to be in the market because my Volt battery warranty expires in December of 24. So I think it is deeply irrational for any consumer to ever own an electric vehicle outside of warranty, because the vehicle will be totaled if a battery module or the pack fails. It's just the math. And I see people in our Tesla channel talking about this idea that Tesla is going to make these vehicles out of one piece of metal. Well, repairability is going to go to dog shit. That means these vehicles aren't going to last very long. If there's an incident that might have required a few thousand in repairs, it's going to instead require the vehicle to be totaled in full. Which, if your model is keep selling new ones because the tax credits incentivize new vehicle sales, well, then maybe that makes sense. Maybe you're going to get to the long purported 25,000 model, and less the tax credit. Now you're talking about a teens fully electric vehicle, which I think is, again, continued pie in the sky hopefulness, and it's not going to happen.
Yeah, it's a difficult market to be in autos, especially with the Chinese manufacturers just moving so quickly. They move so quickly, and
I mean, we
a
gave
lot
it
of
to them,
people are
right?
caught on their heels.
The bankruptcy
Yeah,
of A123, where the Chinese basically were able to take the LFP patents for pennies and work on that,
yeah,
ahead of the Americans for, half a decade, almost a decade. That's given them this head start and this advantage. The fact that they own, the LFP IP, because LFP just most people don't need performance cars, and LFP, lithium iron phosphate chemistry, is inherently lower cost. You don't have the rare earths that you would have in a nickel, cobalt, aluminum, or nickel, cobalt, manganese chemistry. And you may be forsaking some of the 0 to 60 speed that Muskers tout,
yeah,
which I don't think I've ever tested the 0 to 60 on any one of my vehicles I've owned in my lifetime. So to me, it's an irrelevant metric. And I think to most consumers, it's a wholly irrelevant metric.
yeah,
You could outfit the fleet in full with LFP. You're going to have a longer operating life. You're going to have a little bit less power. Assuming you're not in a very cold climate, you should be just fine. In terms of degradation, LFP makes sense to me. Like there should be more LFP,
and
but again, the Chinese own
Teslas
it,
use
and
them.
that's the problem.
Yeah, the Teslas have them. If you look at like a Chinese Tesla, they go 0 to 60 in like 6 seconds, right? 6 or 7 seconds, I think, for those Chinese ones, the long range ones or the standard range.
How does that compare to
So
their
the
NCM
NCM,
chemistry?
those do like under 4
Yep.
seconds. So it's a noticeable
Yep.
difference. But like, yeah, who cares?
Exactly.
Right? Like, as long as you're not stuck.
You're still going to have a instant torque. You're still going to have all the things that people do like about EV. Again, you're not going to have a sports car outfitted with an LFP pack.
Yeah.
That's fine, though. Sports cars are a small minority of the market.
Yeah, I think honestly, 0 to 30 is more important for me. Going around town at a stoplight.
I know
yeah,
all of what we're saying is anathema to
covered.
Joe, who loves his big fuel guzzling internal combustion beasts.
Oh, I love it. But yeah, I mean, as a car guy, like, I think 0 to 60 is an incredibly overrated metric.
Yeah.
People in EVs do care about that. I love anyone I meet that owns a Tesla is like, that's their talking point when they talk to other people.
And it's like, how many times have you ever used that in real life, bro?
Yeah, but it doesn't really matter, and it doesn't make a car feel sporty. Like, I'd rather be in a Mazda Miata if I'm looking for a sports car feel, which is going to have a 0 to 60 10 times as long as a Model 3 performance, but it's going to be a fun car to drive. And I don't think Teslas are particularly fun cars to drive. The features, the technology, that's all very fascinating, and that's all where like the thrill can be derived from. But 0 to 60 is a bit of a overrated statistic when it comes to people in the EV space.
All right. Well, we don't have to keep talking about cars. If people want to talk about anything else, we'll probably cut it a little short this afternoon. Maybe we'll go to 5:30. Let's see. But yeah, we walked through, just kind of recap. This is our 50th. That is 50. So halfway to the century mark of these weekly broadcasts that we host. And I was going to remind people, we're not doing this to sell you anything. Wook Capital exists with this vision that we can achieve investment alpha over the long term through curating crowdsourced research from retail investors worldwide. And 2020 into the whole, of course, GameStop saga that we were fortunate to participate within, informed the view the fund wouldn't exist were it not for all of that. So we're not trying to sell you on anything, and obviously our opinions could be wrong. But our intention is to hopefully learn more about various markets, industries, sectors, identify unloved, mispriced opportunities, and to share information. And we're not asking of anything from anyone in return. We'd love it if you'd participate in the discussions with us. If you want to just be a listener, that's okay. We do have the Discord, which, Joe, I don't know how many thousand people are technically in it, but if you want to, Joe, elaborate on what I'm getting at.
Yeah, we have the Discord server, which you can join by visiting wook.gg. We have had this growing for over 2 years now, I believe. And, thousands of people are in here talking about stocks every day. It's a great conversation. I think it's informed many, many traders, and I really appreciate having it. If anyone wants to join, check it out. There'll be the invite at wook.gg.
Yep.
Fantastic.
I did see, Chris, last night that the Bed Bath bankruptcy plan was approved by the judge.
Oh, nice.
Yeah, so the silliness should be over soon. I'm curious.
I don't know when they'll actually cancel the ticker.
Yeah, it should be a matter of days. But, the plan waived the 14-day, delay.
Are they still paying out anything to creditors, or are they done with that? Pretty much.
The plan called for the 0 to 2.5% recovery for the unsecured creditors. I don't have it in front of me across the classes, but it's a bankruptcy. It was a Chapter 11 that was intended to sell these businesses as going concerns. And as any rational market participant knows, the M&A market has been pretty weak. The demand for a specialty retailer, it wasn't the right market to be a forced seller, and they didn't get a going concern bid that they were able to accept for either of the businesses. Therefore, it is at this point, they didn't formally change it to Chapter 7, but the outcome is a Chapter 7 outcome. The outcome is a complete liquidation, and it's an unfortunate result for everybody. Nobody really did well, unless you were a short seller.
It was actually like a Section 363, right, where they kind of speed ran the liquidation.
Right, they were trying to get this done as soon as possible to preserve any recovery for the unsecured creditors, and it looks like there's a very small recovery, which is better than zero. But if you are a holder of the token, your token, is going to be, what is the language? I had put it in Discord last night. Let me locate it. Oh no, I had tweeted about it on my personal handle, excuse me. So I will read it verbatim because clearly it's unclear to the apes, but the plan calls for each allowed interest in BBB shall be canceled, released, and extinguished, and will be of no further force or effect, and no holder of interests in BBB, this would be the common stockholders, shall be entitled to any recovery or distribution under the plan on account of such interests. So those interests will be canceled, released, and extinguished with no recovery. Unfortunately, there's this strange cult. I don't know if people are being paid to shill it. I don't understand what's going on behind the scenes there. I think there were bad actors. And whether it's just that they're doing it as part of a cruel game, I don't know if it's that or if it's something more nefarious, but just extraordinary amounts of misinformation. I mean, I scroll Reddit, and unfortunately, once you go into one of these subs, it tells you, oh, you might be interested in more of this, and you just see these people that it's pretty clear they're just trying to get eyeballs to get people to send them tips when they host YouTube streams. But the common stock is worthless, will be canceled imminently, and despite all of that, it looks like it's still trading at $130 million market cap. So hopefully we don't have to talk about it for much longer, whether it's canceled next week or the following.
There's this one tweet I shared with you. I don't know if you read it, but this guy was just talking about these, he was talking about AMC, but I think this applies here as well. Like he said that he doesn't know why anyone's surprised about this, because anyone who's watched Kitchen Nightmares reruns during COVID knows that people will burn their life to the ground before admitting they're wrong.
What didn't it specifically say? Middling IQ people. Well, look, I mean, this one was somewhat unique, because I remember watching it very closely. You were.
Yeah.
I watched when Cohen got involved, March of last year. I watched it. We at Wook Capital conducted an analysis. John asked me to conduct an analysis after Cohen got involved. My analysis told me this is not something that one wants to invest in the equity. I at that point in time thought it's probably going to go bankrupt, but it wasn't a certainty. But as the company failed to monetize, they waited too long to start. Because they were literally buying back stock still in 2022, right? In the beginning of the year. So that was the problem. The company's capital allocation decision making, the business just deteriorated very quickly. They tried to kind of do a strategic pivot, and it was too little, too late. And it just became the kind of second to GME meme when it got on Wall Street Bets in August of 22. It got, again, people pumping it on Wall Street Bets, people trying to send it up. Obviously, the Cohen involvement spurred some of that. I mean, I don't know, Joe. You're the one who interviewed him. I thought he was pretty clear in the interview, but clearly, some people want to believe that he's going to buy this shell. I don't know what exactly their theory is at this point. Given the plan seems pretty straightforward to me, but yeah, the delusion is deep.
Yeah, every time I spoke with him and brought up BBBY, it was the same answer. It was the same thesis changed. His he didn't feel as confident in his investment anymore, so he sold. He was off. From my perspective, what I noticed, what I could tell, is he was offered an out, and he took the out, and it did seemingly damage his reputation. But there are still a cult of people that believe he's going to end up purchasing BBBYQ, and you got to feel bad for those people. I'm not gonna say there's a 0% chance. It's just people read filings incorrectly, and I think a lot of that is because the jargon in these filings is meant to be a bit confusing.
Some of it I can't go along with that. Some of it it's clearly nefarious. They literally do interpret the opposite purposefully, and I get it. Like, some of it is hard to understand, but with the consistency, it's one of those things where some of them, I don't want to even name them, but some of them, I think it's very clear they're bad actors, and what their rationale for acting.
Oh, I can agree with that. I mean, over 100 million in market cap still on a company that's going to be delisted.
It's been delisted.
Only a matter of
the interests are going to be extinguished, canceled. The plan's been approved by the judge. There's no assets left. I mean, the latest 8K showed I think they had like 1.2 million in remaining cash. It's funny. I saw that the liquidating trust actually Ryder, because Ryder was one of the creditors, because Ryder had signed this warehousing agreement with Bed Bath in 21. And one of Ryder's employees is one of the committee members on the liquidating trust, because Ryder isn't going to get all of its money back. And it's like these are those people have to be paid before equity sees a dime, and there's just I go back to the whole Hertz bankruptcy. A lot of people who are new to financial markets, who don't understand how this stuff works, will latch onto that outlier and think that's normal, and think that because it happened to them, maybe it could happen to me. And all of these people that are on social media keep saying maybe it could happen, and they're so sure of it. And again, you just need to be very cautious. I mean, look, I have a very small personal short. Wook has no position, but I'm saddened by the lack of critical thinking and by the willingness to just literally throw one's money away. There's this one guy on the server, shout out to @Keitra. Like, I've been trying to tell the guy, I understand you're down, 90 whatever percent, but every day you don't sell, like you still have thousands of dollars invested, and you're making a conscious decision to keep those thousands of dollars invested in this security that the court has made clear will be extinguished. Sell and take your capital, and you can redeploy it elsewhere. It's unfortunate to take the loss, but I think it's just so many of these people new to markets, like, there's this deep set sunk cost fallacy, and until they sell, like, I know, Joe, we've talked about it before with some of the different meme stocks, like, until they sell, they don't get that post-nut clarity.
100%. It becomes a cult. It becomes more like sports than investing. You see people pick their favorite team, whether it's NC or BBBYQ. They pick a team, and they feel like there's a sense of camaraderie amongst everyone. It's not really investing.
Yeah. Well, all right. So it's 5:04. So we spent about an hour kind of talking through the prepared remarks, and then obviously us talking now about bankrupt tokens. I'm just scrolling through the kind of stories that I put in my notepad throughout the week. One thing I wanted to point out from the New York Fed survey that came out earlier this week. So they put out a survey of consumer expectations. You get 1 year, 3 year, 5 year inflation expectations. You also get a query about, is credit harder to obtain than a year ago? And you're pushing up past 60% of consumers saying credit is harder to obtain than a year ago. That's obviously consumers. If you look at like commercial and industrial, the kind of SLOOS surveys, senior loan officers surveys have kind of shown as well. So like, as you would expect with this rapid rate hike campaign, credit is much tighter today than it was a year ago. And that is true for everyone across the spectrum. And it is going to, over time, do what the Fed wants. But where do we get to, I guess, between now and then, between the reported PCE number being at that 2% number? The chair noted, I think it was at the last open market committee presser, that look, by the time the rate is at the target, it would have been too late, right? The Fed needs to loosen before they need to loosen the restrictive policy before the core PCE number gets to target. So how far from that target and the kind of the rate of change, that'll be the stuff that we'll probably get some more clarity next week on what they're hearing and seeing. And then obviously November again. I do not think that unless something were to change meaningfully from like the status quo, that there would be another hike. I think it's over. But yeah, we'll see. And then just a couple comments on freight markets, because look, that's something I'm more competent to speak to than a lot of the other sectors out there and industries. But you got a lot of commentary this week from different people kind of with good outlook, better outlook for both the truckload freight market as well as kind of the equipment side of things. I think I talked about it on Wednesday. You look at kind of the forecasts for Class 8 equipment sales next year, and we're still above replacement level. We're still, 5 to 10% above replacement level expectation from, your ACT research, your FTR intelligence, insert sell side analysts, here, who oftentimes the sell side analysts are just, piggybacking off what FTR or ACT says. But you still got an equipment market that is not undergoing what would normally be like a down part of the cycle. Even into 24, you're still going to actually have production and sales in excess of replacement level, and the lead times are still in excess of 6 months. So you're still kind of above what would be more of a sweet spot. So you're getting more into balance on the equipment side, but you're not quite there yet. And then the truckload carriers, the commentary has been along the lines of, a muted peak season, but Werner, W-E-R-N-E-R, I think their symbol is W-E-R-N, but they're a publicly traded truckload carrier who hauls a lot of dedicated contract carriage for folks like Dollar General or Dollar Tree, like they are the ones replenishing those stores on a regular basis, of course, and home improvement stores as well. But they're saying, quote, "We're only now starting to find some sense of balance in the market. While truckload capacity has been leaving in dribs and drabs for a year now, the exit rate is increasing." Something I've talked about for some time. The influx of capacity into the market over the preceding 2 years was extraordinary, and it's been exiting the market due to the depressed rates that are below operating costs, but it takes time. But Leathers noted, quote, "I think you're going to start to see that wash increase from here." So it was him, it was Schneider, which is another, they have both intermodal and dedicated contract carriage. But the expectation is that the bottom is in, it sounds like, from both them, from Freight Waves, that, while that doesn't mean that it's boom times ahead, it means that the rate of change, like things are getting better than worse. And I think that that's a good thing. You want to see it stabilize. So freight markets, the ISM manufacturing number, I think the bottom is in. The numbers below 50, of course, are still contracting, but I think that the number will continue to rise. There's just a lot of fiscal spend still in the pipeline, a lot of construction and infrastructure spend that supports freight movement. Obviously, the consumer is the bulk of freight movement, but a lot of inventories have been effectively right-sized, and I think it's smoother sailing ahead. So I'll leave it at that. Questions or anybody want to take it elsewhere? Here's another interesting one I saw this week, earlier in the week. The J.M. Smucker buying Hostess for 5.6 billion. If you would have told me after Hostess's multiple bankruptcies, a decade and a half ago, that they get sold for 5.5 billion to Smucker, yeah, I would have been very surprised, and I would have disbelieved it.
Do you think this deal is going to go through?
What do you mean?
The Hostess Smucker
Why
deal?
wouldn't it?
I don't know. I just remember it was announced that there was interest, but I guess yeah. Why not?
I mean, the theme, which I know there was Campbell's Soup bought Rouse sauces a couple weeks back as well. What was it? It was last month. And I think that a lot of these companies are now looking to M&A to to pay for growth, to pay for some inorganic growth. So, I mean, generally that's value destructive. We'll see what happens with this deal for Hostess, not Twinkies. Sorry, Twinkies, of course, being the
The
one of the
ticker.
big brands in the Hostess portfolio. But yeah, I mean, it
But
looks to me like you've got the big kind of some of the big food players just paying up for growth, and it'll probably be negative returns on capital. It'll be destruction of capital, but at least management can tout that their growth number is going up.
I was short Hostess for like a week or two a while back because of the GLP-1 drugs that were coming
Oof.
out. They're getting popular, and I closed right for a small gain. I was like, I don't want to just wait for this. Um, but yeah, I got lucky, I guess. Um, yeah, like you said, like they've been through multiple bankruptcies. Um, I think they had warrants, but I think they expired. Um, but yeah, I think it's not a great acquisition, right? I mean, you have these, these products that are, consumed by, people who, now have an option to, lose a lot of weight really quickly. So I don't know. I mean, maybe it's just too much of a micro, or simplistic analysis. Um, but it doesn't seem like a great acquisition. I think 17 times EBITDA
Yikes.
doesn't seem great for such a, it's not even a very high quality, consumer staple, really. I mean, I don't know. I think Larry Cheng had a tweet um, about buying revenue, and like how like it's kind of like overrated to just seek revenue at at the expense of anything. But yeah, might work out for them, I guess.
It looks like they're currently trading at 16 times EBITDA on an enterprise value basis. So, I mean, it's rich. Um, it's not. I don't know. It's rich. No pun intended. Very sweet. Very sweet offer.
Randall, you asked to speak. How's it going, buddy? You are muted, by the way.
Sorry about that. I got distracted there. Um, it was regarding Bed Bath & Beyond. I don't really think there's any bad actors here. I think these people are mentally ill. Like no matter what bad things happen to this company, no matter the bad news that comes out, they just somehow spin it into something positive, and it's all of them. They're all doing it. It's not like they're all bad actors. Like I like to listen to the PP show for a few hours a day, and it's like these guys are insane. They've completely lost their touch with reality, and I think it's almost like a religious thing for them. Like they worship Ryan Cohen as if he's God, right? And they assume that he never abandoned the plane, that he wouldn't abandon his worshipers or followers. And you know, they don't factor in that Ryan, right on Joe's interview, said his feelings changed on the company. It's clear as day to most people. Now they say, oh, well, Ryan Cohen's a creditor, and this, I don't know what any of that means, to be honest. Why he appears as a creditor in the filings or whatever. But like the company was telling everybody that they were planning to file Chapter 11 long before they filed Chapter 11, and everybody said it was bullshit. It wasn't bullshit.
I didn't say it was bullshit.
Well, no, you didn't. But all of these Bed Bath & Beyond communities I follow, it's just insanity. Like these people have completely lost their grip on reality.
How do you rehabilitate people from that? Because I'm not sure I agree with your contention that it's a mental illness issue. I mean, I think some of them know good and well the truth, and it's a clout thing. It's a I can grift thing, and tip me for running my show.
Maybe the influencers, maybe some of the influencers involved. Yes, but I think a lot of the people are just drinking the Kool-Aid.
Well,
hey Rocket, do you think Kai Smollett is a bad actor?
No, he's just insane. Look at the stuff he does, where he's like going into news reporters and yelling into the camera, and going to the building that this former CFO committed suicide at, and harassing the security guard and things like that. Like that, a normal person doesn't do stuff like that, right? Like he's insane too. They've all lost their mind, and how do they come back to the reality? Well, they got to go through the 5 stages of grief, and all of them are still in the first stage of denial, right? So it's going to be probably a long time after the shares have been canceled that reality begins to sink in. But will they ever abandon their worship of Ryan Cohen? I don't think so. I think that these are like cultist people, and if they weren't obsessed with Ryan Cohen and Bill Pulte and these rich figures that they surround themselves with, that live in their heads every day, they would be worshiping something else. It would be some other conspiracy theory, or
maybe Trump.
It could be Trump.
Find a rich man,
another rich man. Like it's amazing. It's amazing to watch. It perplexes me.
Yeah.
I feel sorry for these people, and it's weird because with you guys and your connection with Cohen, right? Like I think Rod has said in the past that Joe knows Cohen's PR guy. Like he probably has an email address or a phone number for Ryan's PR guy.
When we spoke with him earlier this year, one thing he said was that he understands now, I think, in a way that he probably didn't, and I wouldn't have if I were in his shoes, kind of the impact of becoming involved with any equity publicly has on some of these market participants. So I do think it makes sense why he's kind of toned back this year some of his goofy tweets and the like, because I think he understands that some of these people are, for lack of a better word, ape shit. But again, I don't know.
The point I wanted to make was that these guys all hate Rod, right? Like, especially the Salvatore person is just obsessed with Rod. And he was complaining about Rod last night on the stream, and I guess they like bombed one of your last streams where they came in and
he came in on Wednesday and decided to fling ape poop.
Well, they were all really proud of that on the PP show, let me tell you. And I was rolling my eyes because, being that you guys are the figureheads or the heads of GMEDD, and Joe being the one that actually interviewed Cohen, you would think that maybe you guys would have some more foresight into what Ryan Cohen's thinking, and knowing that Rod is short the stock would probably change some opinions. No, it hasn't. It's complete delusion. I don't think there's any bad actors here. I think these are people that are completely delusional, right? And delusions of grandeur, maybe because they think they're going to get rich from a trade that's never going to happen, right? Where they think the stock's going to rocket up to $10 trillion a share. There's this one guy named OK Bet. I've seen him on the stream, I think 2 times say this, where he thinks Bed Bath & Beyond was going to go up to $100 trillion market cap. Absolutely not going to happen.
Even GameStop during the peak of the mania got, 30-odd billion market cap? So
they turned off the buy button.
Exactly.
Yeah.
And this is not part of a free and fair market, is having stocks gap up on short sellers. Just like it's not part of a free and fair market to have stocks gap down on longs. That's why you have limit up, limit down halts and all these things in the market. The SEC, FINRA, all these SROs, they don't want extreme market volatility like these squeezers are trying to shoot for. And look at this whole MMTLP thing where FINRA canceled trading on it. If for some reason Ryan Cohen was somehow involved in BBBY, they would just shut it down anyway, right? If there was some kind of monumental short squeeze about to happen, they would just shut it down. They would shut it down before it got to $5 probably. And these guys don't understand that. They think for some reason
I don't think they understand why a short squeeze happens. Like, think about something like a Carvana, where you had the folks who were shorting the stock expecting a bankruptcy outcome in the near term that would likely wipe equity. When that changed as a result of the restructuring, they covered. There was a short squeeze. There was a lot of buying from them, right? I think that there's just a fundamental misunderstanding of why that might happen, and they think they saw obviously Jan 21, and that's probably their first experience with markets for a lot of these people. I know that silly Vitor guy was pumping AMC in 2021. So these are people who aren't sophisticated market participants. They're at the peak of the Dunning-Kruger, right? They have such little understanding. They think they know everything. So that might be the case. To your point, maybe they're not all bad actors. I do think some of them may be, but it's just that they're at that point where they have to realize how little they know and eat that humble pie, like we've all done at some point in our lives. With this particular one, it's again, you literally can see that it is in bankruptcy court. There was a plan proposed to extinguish the equity interests with no recovery. The plan was approved by the judge last night, and the equity interests will be extinguished in short order. And again, I'm not telling people that still have their money in it, don't focus on the sunk cost aspect. Don't focus on what your cost basis is. That's completely irrelevant to what happens next. And the fact that they've had days, they've had months to exit and retain what's left of their investment. It's just a lot of delusion. I don't know. It's really just frustrating to me too, because as you noted, they they run their little YouTube streams and they do their little whatever it is that they're doing, and what we are trying to do is ideally become more informed and better investors. And it's almost like the absolute opposite end of the spectrum, where these people are proud that they are ignorant to reality.
I agree, but I don't know if that they're not. It's not that they're proud that they're ignorant of reality. They're not really proud that they're because they're ignorant of reality. They can't be proud of that fact, right? Because they're just completely unaware in the first place. And you know what? I don't think that when the equity gets canceled that they're going to, all realize this
Not
all
all,
at
not
once?
all of them are gonna. I mean, there's definitely gonna be some, right? There's the MMTLP goofballs that are still. I don't know what they're holding out hope for, but you're right. There's going to be a handful that continue doing this for as long as they can keep the grift going. I mean, the
Well, they'll still
Peaky
start. They'll
Show
start a
guy, like he's doing it to get tips, and he's made it clear, and he's proud that people are tipping him for keeping this kind of, you know, silly talk show going. But you know, as long as he's getting money from people, he's going to keep doing it. And you know, if he doesn't have a position and he's not really explicitly saying too much, like you have to walk a fine line about market manipulation because look, unlike them, I've had to deal with an SEC subpoena, and it is not a fun experience to have to go through. So, you know, it would be better if more of these people actually had to face the repercussions. I mean, I'm happy to see that the pump and dumpers of the 2020, 2021, the Zach Morrises of the world, you know, are dealing with that and being held to account for what they've done. You know, which would be stuff like claiming they were buying when in fact they were selling. That is market manipulation. That is illegal. They, too many of these new market participants think it's okay to manipulate markets because they perceive that, founded or unfounded, the big players are manipulating markets, right? I think that's what it kind of gets back to is there's a
and
perception.
they think that they also think the not financial advice disclaimer gets them off the hook, and it doesn't.
No.
I think a lot of it really stems from just how incredible what happened in January was for GameStop, and a lot of people that are in these cults that have been created since then, like AMC, BBBYQ. It's just a lot of it's a lot of decisions being made on the fact that they feel like they missed out. I think, and seeing what happened to GameStop, seeing literally a line that goes straight up, changing so many people's lives, and feeling like they missed out. They're hoping they can find the next one, because when you look at people that did invest in GameStop early on in the single digits and low double digits, these people didn't go and then like think it's all going to happen again. I think a lot of the people that were in this recognize that it was like an incredible market event, and we've since, I think almost every hedge fund now has a line, on their risk sheet, like, is there a potential for a meme frenzy here, and like no stock's ever going to be shorted over 100% again, most likely not, at least not in the next few decades, until people forget what could happen. But I don't know, that's how I say it. I think a lot of people missed out on GameStop, and they're hoping it happens again.
Well, and that setup will never happen again, too. Like, everybody was locked in their homes, right? They had nothing else to do with their time. They had all these stimulus checks given to them, and then they, find this Reddit forum and they all just pile in. Like,
the thing that I find funny, Randall, is like you got the what is the damn movie called? The Dumb Money movie that just came out, and that fictionalizes the Roaring Kitty, Keith Gill's character. But for those of us who actually, it was quite literally less than 3 dozen, maybe 2 dozen, like regulars who tuned into his YouTube streams and had constructive dialogue about all of the news items impacting the business, the latest quarterly filing, whatever it is. Like the perception of what it was after the fact is just so different from what the reality was of experiencing it. It's been made out to be something that it isn't. I don't think he'll ever. I hope he's not found, because I spoke with him regularly. I considered him a friend. I mean, unfortunately, he's been completely MIA, and I get it. Whether he wants to ever deal with this again, because look, like you said, you have got a lot of these people that literally put this guy on a pedestal, not just Ryan Cohen. It's
they worship
DFV,
him.
They worship him, right? So if I were him, I wouldn't want to have to deal with that. So I wouldn't have to come back and have literally everything I do. I mean, he's probably had to acquire security. You got crazy people like Kai's, whatever his name is, out there that are stalking people. So it's just the reality is different than the fiction. I'm very proud of my whole experience and my involvement with it. And I was telling people to sell during that mania week. I was posting on my Twitter, hey, I sold another X% of my position. Like, there was no fundamental justification for the value to be what it was during that week in January 21. And anyone who claimed otherwise was deluding themselves. But it was a mania. It was one of the most prolific manias of our time. And like you said, it probably won't be recreated. There were quite the unique set of circumstances that allowed it to happen. But I might go watch the movie. I mean, if you want to be entertained, but bear in mind, that's not the truth. It's just a fictionalization. All right. Well, we spent a little while going off the deep end there, but I think let's leave it at that. It's 5:30. I'd like to start my weekend. I'm going to step away. Joe, can you kind of run us through? And Randall, thank you for tuning in. Enjoyed hearing you for the first time, I think, on audio. Apologies if you had spoken in the past and I'm forgetting. But Chris, as always, appreciate you tuning in and joining on the speaker panel. Joe, can you maybe recap what we've got coming up on the programming slate and just maybe remind people why we do these?
Yeah, we do these to recap market events over the week, build a community. Hopefully we can all discover some golden nuggets of knowledge together, like we briefly talked about earlier. A Roaring Kitty YouTube streams were maybe a couple dozen people at the peak, and at these lows, sometimes he was streaming to just 4 or 5 of us. It was a very small group, and still, having that community to discuss trades is what enabled us to all continue to invest in GameStop. It was a great community. We all did productive research on the company during these streams, so we're hoping to kind of recreate that kind of feel with our Twitter spaces. So feel free to tune in every Friday to these discussions. We also have a Wednesday open mic, and we're considering moving around some time slots, so definitely stay following our Twitter accounts for the latest news on that. Also tune into our Discord at wook.gg or discord.gg/GMEDD. And over there, you can talk with a few other 1,000 investors about any company you'd like to discuss. So it's a pretty big community there. We have discussions going on 24/7. So tune in there. And as always, thank you guys for tuning in. Thanks for listening. Check out GMEDD on Twitter for the Wednesday open mic. That'll be our next broadcast. We also have a book club coming up at the end of the month. So definitely stay in the loop by following us on Twitter.
All right, everyone. Thanks, Joe. Have a great weekend. We look forward to talking to you soon. Cheers, everybody.